This video is going to explain what a strike price is for options in the stock market. First, I'm going to go over the formal definition, which might be a little bit hard to digest at first, but then I'm going to explain in easier terms to understand what a strike price is. So the formal definition is that the strike price is the price at which your option can be exercised. So keep in mind that options represent an option to buy or sell an underlying stock. So on the screen here, I have an options chain for Apple. So Apple is the underlying stock in this example, and these are all options for Apple. So the strike price, for example, on the call options over here, these are the call options. The strike price for call options is the price at which Apple stock can be bought. This right here is a list of all the strike prices available for this series of options. And for this series, I'm specifically referring to the July 14th expiration of options. So these are all the strike prices. So for example, this 150 strike, these are the call options available for Apple at the 150 strike for July 14th. And 150 again represents the price at which Apple stock can be bought using this option. So let's take that 150 strike and think about what that might mean. So no matter what the price of Apple stock is, this option gives you the right to buy it at $150. So if this price of Apple stock is $100, this option gives you the right to buy it for $150. As you can imagine, that option would have very little value if the stock price of Apple was just $100, because why would you even want to buy it for $150? If the stock price of Apple were around $200, then this option would have some value because you'd be allowed to buy it for $150. Okay, now as far as put options go, and puts are on the right side of the options chain, a strike price for put options is the price at which the stock can be sold. So it's kind of the opposite of call options. Now, a lot of people who invest with options don't actually intend to exercise the option. So there's especially with active traders, there's a lot of traders who just buy and sell the option without ever having any intention of exercising the option or owning the underlying stock. So swing traders and day traders, as an example, people who make trades or investments that are intended to be held just for a short period of time, say a matter of days or weeks, they're just buying and selling the options with the intention of making a profit on that difference in price of the option itself. Now, some strike prices are considered in the money and some are considered out of the money, and it can be helpful to understand the difference. So you can see this huge spectrum of strike prices available for the July 14th expiration of options for Apple. The ones that are in the money are the ones that have intrinsic value. So when it comes to call options, ones that have intrinsic value are ones where the strike price is lower than the stock price. And let's think of this with the 150 strike as an example. We know Apple stock right now is selling for $190.68. We talked earlier about how if the strike price is lower than the stock price, then you could exercise the option at that strike price and effectively buy Apple stock for $150. So a given strike price of call option has intrinsic value when the strike price is lower than the stock price. It means that you basically could be buying the stock for below its current stock price. That's how you know that the option has intrinsic value when it comes to call options. So those are the ones that are in the money. And here on the options chain, you can see that reflected by all these options that have a navy blue background. An option strike price is considered out of the money if the stock price is lower than the strike price, and they're reflected here with a black background. So again, let's take an example, the 200 strike price. We're saying with a call option that you can buy Apple stock today for $200 using an option with the 200 strike price. But why would you do that if the stock price is below $200? There's no reason you would do that today. You'd be paying more for the stock than you could if you just bought the stock outright. So those strike prices are considered out of the money. Of course, we haven't reached the expiration date yet, and that's why there's still some value here to this particular strike price. You can see the bid and ask here. This is the bid column and the ask column that reflect the price of this particular call option. And there is some value, between 5 to 6 cents a contract, for the 200 strike. The reason it has value is because before the expiration, the stock price might move up enough to be above $200, in which case there could be intrinsic value before the expiration date. Another thing that's helpful to be aware of is how the price of the option differs based on the strike price. So one component of an option's price is its intrinsic value. We've already talked about this. And as you can imagine, the lower the strike price for a call option, the higher its intrinsic value. And the reason is because if you take the stock price and subtract the strike price when it comes to a call option, that gives you its intrinsic value. So for the 150 strike, for example, $190.68 is the stock price. That means that the 150 strike has $40.68 of intrinsic value. Now, if you looked at the 100 strike, it would have $90.68 of intrinsic value. So as you can imagine, the lower the strike price for a call option, the higher the intrinsic value. Option prices, though, are made up of two components, not just intrinsic value, but also extrinsic value. And the extrinsic value can be thought of as the premium you pay to control an option. And it's made up of a variety of factors, such as the time value of the option and the volatility of either the underlying stock or the stock market. Rather than trying to understand exactly how the extrinsic value is computed, it might be helpful just to be aware that it exists. And an example of the extrinsic value can be seen in these out-of-the-money strike price options for call options. So we talked earlier about the 200 strike call option for Apple. The stock price is below $200, but there's still value to the option. It has no intrinsic value, as we explained earlier, since the stock price is lower than the strike price. But you'll notice there still is a cost to it. That represents extrinsic value. We talked about how between now and the time that this option expires, the price could go up and get above $200 and have intrinsic value. And that's what this cost represents, is that premium to be able to control the option and have the possibility that it could gain value. Now, the amount of extrinsic value that any given option might have could depend on its strike price. And you can see that reflected here with these out-of-the-money options. So again, this series of strike prices is all out of the money. The strike price is higher than the current stock price. Now, if you look at the cost here of these options, and again, this is the bid, this is the ask, that means the prevailing price right now is probably somewhere between these two numbers. You'll notice that the price is different based on the strike price. So all of these are made up exclusively of extrinsic value. They have no intrinsic value, and yet the price is different. And you'll notice that the higher the strike price is, the lower the value of the option. In other words, the lower the amount of extrinsic value for these call options. And that demonstrates one of the typical aspects of how extrinsic value relates to the strike price. And it is this: the closer that the strike price is to the current stock price, typically the higher its extrinsic value. And so as you go further and further away here, as the strike price is further from the current stock price, the lower the extrinsic value is. It can be seen pretty clearly here with these out-of-the-money options, but the same is true with in-the-money options. The deeper in the money that the strike price is, typically the lower its extrinsic value. So all that gives you a lot of information that can help inform your options investing strategies. You now understand how the prices of options differ based on the strike price, and how some are in the money and out of the money, and what that means. So which is the best strike price to choose? It totally depends on what your options investing strategy is. Are you interested in calls or puts? Are you looking to buy or sell options? There are so many different factors based on what exactly you're trying to accomplish. And so the strike to choose might depend on what exactly your strategy is or what your objective is. In terms of the stock's price, sometimes we get asked whether it's tied to the strike price at all. And the answer is no. It's totally independent. The stock price is moving based on all sorts of different market supply and demand factors, and it's not tied in any way to the strike price. They move independently of the strike price. Another question we sometimes get asked is related to active trading of options. So for example, if you buy a call option and you don't have any intention of exercising the option, you just are hoping to sell the option later for a profit, that is considered active trading of options. And some people get confused about how the strike price relates to your objective in terms of active trading of options. So because the strike price is the price at which you can exercise the option, there sometimes is confusion that for an active trader, that somehow influences your decision making on the trade itself. So for example, I'm going to go to the chart here for Apple. The stock price is $190.68 right here. Some people get confused and think, okay, if I buy a 185 strike call option and the stock price goes down to $185, then I need to exit the trade. And that's not necessarily true. Or they might think, if I have an objective or a hope that the stock price is going to get to $195, then I need to buy a 195 strike call option. And those are perfectly valid trading decisions, but they don't necessarily need to be that way. In other words, if you're hoping the stock price gets to $195, you don't need to buy a 195 strike option if you're an active options trader. If you're planning to exercise the option, that's a completely different agenda, right? But if your goal is just to buy an option and sell it later for a higher price, for example, with a call option, you don't have to buy a 195 strike option to accomplish that. There's a whole series of options, a whole series of strike prices to choose from. So if you bought a 180 strike call option right now, as the stock price is 190.68, and the stock price went up to 195, you could profit from that. If you bought a 175 strike call option and the stock price went up from 190.68 up to 195, you could profit from that. So there are different strike prices to use, and the strike price is not necessarily tied in any way to your profit target or your stop loss. The point I'm trying to make here is that if you are not planning to exercise the option, in other words, if you're an active options trader and you're planning to just buy and sell the option itself, then the way that the strike price relates to the stock price in and of itself doesn't matter. It only matters insofar as it affects the options price. In other words, if you're an active options trader, all that matters is the option price itself. And understanding the characteristics of the option prices as they relate to each of these strike prices can be helpful for that purpose. But the way that the stock price relates to the strike price won't matter inherently in and of itself because you aren't planning to exercise the option. It only matters as far as how it affects the option's price. If you have questions about options or about strike prices, we would love to help. We're ready to help. You can reach out to us anytime. Our email address is support@stockmarketguides.com.